I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for InstitutionalAdvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you.
The Toronto and New York stock exchanges are down, but they've had a terrific run up until now.
Oh, yeah, it's been outstanding because, well, in looking back, somewhere around June, there was kind of a positive wave came into things. Business got a bit better, and GDP got a bit better in the U.S., and commodities began to extend their move coming out of the disaster of last January, February. But there was a lot of apprehension around about which way the election would go, which was a huge risk. And then it turns out with the Trump win is, well, you went from the most anti-business administration in American history, even more so than Roosevelt or Wilson, and then into what could be the most pro-business administration in the U.S. history. So it's, politically speaking, very exciting times. And, of course, with that, the stock market really moved up beginning, well, in which index you're looking at, end of October, early September, and then early November. But with the result of the election, then it really started to move. Now, also, in that October, November, whatever items bothering the stock market may have been going to clear anyways on a seasonal basis, you know. So here we had, it took off, and I started using the term that it was rational exuberance, which is a play on back in 1996 when the stock market was getting exceptionally high valuations and attention. And then Chairman of the Fed, Alan Greenspan, declared that it was irrational exuberance. Well, the party kept going until March of 2000, so that's a bit of an irony that's been in the literature ever since. So then in November we started calling the move rational exuberance. Rational because you were having a tremendous change in the administration to pro-business. And then this week we wrote that because you've reached some technical excesses on, like the S&P, we had technical excesses for the bank stocks in the middle of December, and but all you had is a brief correction, and then they've gone up to higher highs. And but at any rate, now with the upside exhaustions and sequential sells in the S&P, that's an accomplishment. So the idea now is that rational is out. Yes, everybody's in. So what you're left with is exuberance. And what is there to support the exuberance? Well, of course, in any exuberant market, the buying is hinged upon that next week or next month or next quarter, there's going to be somebody who will buy at yet ever high price. And that some people have unkindly called the greater fool theory. But anyways, that is the wager that out there, there's still going to be fresh buyers to take the market up. And but the technicals are saying that the market is going to correct, which it has started. But, you know, it's not just the stock market. the action in, as we spoke before the show, that people are looking at exceptional moves in the bond markets. Well, in June last year, the action in the U.S. Treasury market and sovereign bonds in Europe and Canada, of course, became very, very overbought. And we did a special piece calling it ending action, that could be the end of the whole bull market. Now, we concentrated on the U.S. market because in Europe, for example, the central bank is so big, and the bond market, the European credit markets, are not nearly as huge as for the U.S., which is the world's financial center. So we thought that with much more people playing the U.S. market, that the technicals would be more reliable than, say, trying to apply the same technicals to the German bond. So, and that was the argument, that we were getting an important high there, and that investors should shorten term, and that traders could start playing short side. So, well, anyways, the bonds really did sell off until December, when a bounce was possible. But at the same time, in doing that July study on the Treasury market, we noted that the action in low-grade stuff like junk could continue. And has it continued? Because you had two things going on. The European Central Bank was buying European corporates, and that, of course, would be a tremendous prop for corporate bonds in North America. So it continued, and then, of course, you've had now the Trump win, in which case taxes are going to be lowered, which is very good for corporate bonds, and also regulations are going to be diminished, which is also very good for business and corporate bonds. So this is all in the market because this week we've got technical excesses in J&K, HYG, the low-grade stuff. And so a top in this sector is possible, and this would also start to widen credit spreads, because going into last January with the crash in crude oil down to $26, the junk bond market was under tremendous pressure, so that then widened credit spreads hugely, and actually it was a panic. And then now you've had the opposite now, absolute supreme confidence in corporate bonds, and also at the same time as you have, well, we were looking for crude oil to rally out into around March. And so it's now, well, let's put it this way. If crude does one last little pop, that would be a nice finish to the huge move that started, well, we're at hit 55 intraday the other day, and from a low of 26. I mean, really, that's gravy like you wouldn't believe. So you can see the potential for crude oil selling off. And also on two other commodity sectors, the base metals and the agricultural prices reached objectives. We were looking for highs for those in around March, and bang, they got hit yesterday. So it looks like the wave of speculation, which we called rational exuberance, reached enough exuberance that rational was left behind, and perhaps the exuberance is beginning to roll over.
We'll have more with Bob Hoye right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Bob Hoye. Bob, what's going on with gold?
Yeah, we've had a good rally. The U.S. dollar index has been correcting now for 4 or 5 weeks. It got quite excited. It got up to 103.85 and then back down to the 99 level, and it's been sort of like 100 to 101, building a base in here. So that's allowed the pop in gold and silver, and we've had a fairly good rally in the gold stocks. But I noticed yesterday that one of the comforts we look for in the gold sector is to have the gold shares outperforming the bullion price, and that helped us in finding the bottom in November and December. There were 2 lows in there for, well, we used the Hoye divided by the gold bullion price. And then it rallied up quite nicely, as did the gold stocks. But in the last couple of weeks, gold shares have begun to underperform the metal price, and that's a concern. So I think the sector can correct for a while, but this would be a correction within a bull market for precious metal sector, and we prefer to play the stocks rather than the metals. I know you've got a lot of gold bugs out there who are seeing changes in China, and China will be setting up a gold exchange or something or other, and all the buying, and that the Fed is reckless and insane, and that's all true. But it may not necessarily feed into a huge bull market for the metal prices. The reason for that is that in post-bubble contractions, the senior currency, which is still the U.S. dollar, has a tendency to be firm. And for example, with the 2007 bubble, the dollar index got down to, I think it was 71 or 72. And now we're talking about a dollar index up to 101. And so I think that would be a secular low for the dollar, and it's been working on a long recovery since. So this is where I can't get excited about owning gold for the long term, other than, as a portfolio insurance, you want to own some gold for protection. And where you're going to make money in the gold business is in the gold stocks, because you got leverage on price moves in gold. And even if the price doesn't move hugely in the U.S. dollar, we're in an environment where the real price of gold can improve. So all you need to have is the price of gold behaving better than most commodities, particularly oil, because oil represents the cost of power for mining. So, and that has been improving generally for a year, kind of flat in the last couple of months. But this is where in the past, in post-bubble contractions, or you want to call them deflations, I don't mind that term either, that the real price of gold has gone up and the gold mining business has made money, and it becomes the hot sector. So I would just as soon call for the bull market in gold stocks based upon sound, rational history, rather than go out fantasizing about, the Fed is evil and gold's going to go to 10,000. I mean, really, you can't be famous in this business unless you're going to call for $10,000 gold. And, well, Jim, we don't even want to be half famous by calling for $5,000 gold. We're just going to call for, we are in a cyclical bull market for gold mining stocks. Hey, what more do you need to know? It's wonderful, whereby there will be some corrections. So, but the main thing is the long-term view for the gold mining sector is very positive.
Bob, thank you so much for chatting with us.
Yes, Jim, and good to be with you, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. If you have any questions for Bob, you can send them to info@housestreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.